Warren Buffett is widely known as the world's best investor, and when I say that, people typically think of Warren Buffett's very long-term investments in well-known brands, companies like Coca-Cola, Apple, American Express, and more. But Warren Buffett puts money to work in a variety of different situations that he views as intelligent investments. Investments with a high probability of upside and a low probability of a permanent loss of capital. In Buffett's 1988 letter to Berkshire Hathaway shareholders, he explained that his investments generally fall into one of 5 categories. Number 1, long-term common stock investments. 2, medium-term fixed income securities. 3, long-term fixed income securities. 4, short-term cash equivalents. And 5, short-term arbitrage commitments. In this video, I'd like to focus on that final category of short-term arbitrage. Warren Buffett's track record in those types of situations is very good, as was the track record of his mentor Ben Graham. In fact, Warren Buffett himself completed a study of Graham Newman Corp, which was Ben Graham's hedge fund, of their track record in arbitrage from 1926 through to 1956, and he found that they averaged unleveraged returns of about 20% per year. And at the time of writing that letter in the 1980s, Warren Buffett, although he didn't do the exact calculation, was confident enough to say that he believed his own track record in arbitrage situations was even better than Ben Graham's 20% per year. In this video, I want to talk through when and why Buffett invests in these arbitrage situations, what Buffett actually means when he says arbitrage in the first place. I'll take you through a couple of previous Buffett investments where he has been successful in making some of these short-term arbitrage bets, and I also want to talk through a kind of live example that's currently playing out that sits in Warren Buffett's portfolio, which would fall into the category of arbitrage, and that is his current investment in Activision Blizzard. If you enjoyed this video and haven't subscribed to the channel already, please be sure to do so. But without further ado, let's get straight into some of these lessons from Warren Buffett on arbitrage. Now, in Buffett's 1988 letter, he takes the time to explain what he views as a typical arbitrage situation and some of the things that he tends to look out for. He explains, once the word only applied to the simultaneous purchase and sale of securities or foreign exchange in 2 different markets. The goal was to exploit tiny price differentials that might exist between, say, Royal Dutch stock trading in guilders in Amsterdam, pounds in London, and dollars in New York. Some people might call this scalping. It won't surprise you that the practitioners opted for the French term arbitrage. He goes on to say, since World War I, the definition of arbitrage, or risk arbitrage, as it is now sometimes called, has expanded to include the pursuit of profits from an announced corporate event, such as the sale of a company, merger, recapitalization, reorganization, liquidation, self-tender, etc. In most cases, the arbitrager expects to profit regardless of the behavior of the stock market. The major risk he usually faces instead is that the announced event won't happen. And throughout this letter from Buffett, he makes a couple of things very, very clear. Firstly, he says his overwhelming preference is long-term common stock investments, although Buffett's track record is very good and he likely has averaged more than 20% per year in these arbitrage situations. Those 20% per year returns often come in the form of very high annualized returns in a very short period of time. So for example, he might earn 10 or 15% from a arbitrage situation in total, and perhaps that plays out over 6 months and that creates a very high annualized return. But Buffett then has to take that cash and find a new arbitrage situation to put that money back into. He has to pay tax on the profits each time he moves from one situation to the next, and he would much prefer to find one of his classic long-term investments that can compound at a high rate for a long time. On that topic, he says, we prefer, of course, to make major long-term commitments, but we often have more cash than good ideas. At such times, arbitrage sometimes promises much greater returns than treasury bills, and equally important, cools any temptation we may have to relax our standards for long-term investment. Charlie's sign-off after we've talked about an arbitrage commitment is usually, okay, at least it will keep you out of bars. One other thing Buffett makes clear is that if he's ever in an arbitrage situation, it's always around an announced corporate event. He's really not in the business of buying into a company that he thinks might maybe get sold sold to someone in the future. He doesn't want to speculate about that sort of thing. He waits for the real announcement to happen and then assesses the odds and judges whether he wants to make an investment in that particular situation. Now, the first successful arbitrage investment that I want to share in this video that Buffett made was right back in 1954 when Warren Buffett was only 24 years old. He was in New York and working for Ben Graham at the Graham and Newman Corp, and he discovered an arbitrage opportunity in a chocolate products company called Rockwood Co. Now, Rockwood Co, as you might expect, carried an inventory in general of the ingredients that they needed to make their chocolate products, and one of those key ingredients, of course, is cocoa. And something weird kind of happened in the cocoa market in 1954. There was quite a major sort of short-term supply disruption, and it caused the price of cocoa beans to go up substantially. Only 10 years earlier, cocoa beans were worth about 5 cents per pound, and fast forward to 1954, they'd suddenly ballooned upwards to as high as 60 cents per pound. And both Rockwood Co, the company, and a few of their shareholders recognized the fact that Rockwood could actually make more money just by selling off their inventory of cocoa beans than they could by actually turning those cocoa beans into some of their chocolate products. And this created a really interesting arbitrage opportunity. Now, one of the complicating factors with Rockwood Co was actually to do with tax. If Rockwood was simply to sell all their cocoa beans, they would be liable for about a 50% tax on those profits. And thanks to the 1954 tax code, some very switched on shareholders actually discovered a much more efficient way to distribute the cocoa beans and kind of capture the value of that inventory. And there was basically like a loophole, I guess, in the tax code that said if you were selling some of this inventory because you were closing down one of your lines of business, then you would no longer be liable to pay any tax on those distributions. So Rockwood went through the process of terminating specifically their cocoa butter business, which they attributed about 13 million pounds of cocoa beans to, and they then actually allowed shareholders to exchange their stock certificates for literally pounds of cocoa beans. It acted like a share repurchase in many ways, where Rockwood were basically retiring a lot of their shares, but rather than paying cash for the shares, they were basically paying with their inventory of now very valuable cocoa beans. At the time, the situation was basically that for each share of stock, shareholders could obtain about $36 worth of cocoa beans. At the time, shares of the company were trading for about $34 in the stock market, so there was sort of a $2 spread. You could basically buy the stock in the open market, exchange it for cocoa beans, sell the cocoa beans, and capture about a $2 profit on your $34 of capital. So that is exactly what Graham Newman Corp did and what Buffett helped Graham Newman to do. He was kind of busy buying shares in Rockwood, exchanging them for cocoa beans, actually paying for train tickets to then go and exchange the cocoa beans for cash, and it was quite a profitable kind of investment opportunity for Graham Newman. Now, what I actually find kind of interesting, just as a side note here, is that Warren Buffett approached the Rockwood situation a little differently to his mentor Ben Graham. He actually didn't participate in this arbitrage kind of plan as Graham did. He instead actually recognized that this kind of cocoa bean for stock exchange deal effectively valued Rockwood's other assets at zero: their cash, their machinery, customer relationships, receivables. All those things were basically valued at zero given the deal that was happening at the time. And Buffett, in his personal account, actually approached Rockwood as more of like a traditional value investment, where they were effectively buying back a lot of stock and so on. And he actually managed to ride the share price from the $34 where he purchased it to over $100 per share. So Rockwood turned out to be a nice little arbitrage opportunity for Graham Newman Corp. Initially it looked like one of those opportunities for Buffett personally, but the student sort of became the master in that case, and Buffett did far better than Ben Graham in that situation. Now, fast forward from the 1950s to the 1980s, Buffett again got involved in a very profitable arbitrage situation. This one a little more similar to what people might be used to today, but this one does have a little bit of a twist. Essentially, this was in a company in the 1980s called Arcata. Now, Arcata was a paper and forest products company, and they were trading for about $33.50 a share in the market, and they had an offer from a company called Kohlberg Kravis Robertson Co, or KKR, to buy the company out for about $37 per share. Now, additional to the $37 per share, Arcata shareholders would actually be able to keep about 2/3 of the proceeds from a long-running litigation that Arcata was involved in. What sort of cash would eventually be generated from that litigation, if any, was very speculative and very unknown at the time the investment was made, but it was a potential nice kicker on top of just the buyout kind of spread. So you had a nice situation where you could potentially ride the share price from $33.50 to $37, about a 10% gain. It turned into more like a 40% annualized gain because that was expected to happen in quite a short period of time. But you also had this potential other kicker from any cash from a settlement. 2/3 of that would go to the shareholders, and 1/3 would go to KKR, the firm acquiring Arcata. And just for a little bit of background on the litigation that Arcata was involved in, basically they had sold a whole bunch of redwood forestry land to the US government. The US government sort of slowly paid them the money for that after they'd actually already sort of taken over ownership of that particular kind of forestry block, and they also paid them a very small interest rate. It was 6% simple interest. It was 6% simple interest that they basically paid them on the money that Arcata shareholders were still owed, and Arcata ended up taking the US government to court. They were very unhappy about a couple of things. One, they felt that the actual purchase price was really kind of grossly inadequate, and secondly, they also felt that the interest rate of 6% was far too low, and they also wanted it to be paid in a compounded interest fashion as opposed to simple interest. Now, how this one ended up playing out I find really interesting. The initial purchase from KKR did actually fall over. Luckily, Arcata was able to find another purchaser. This time they were paying a slightly lower price, and they were offering only half of the proceeds or potential proceeds from any litigation, but it still worked out very well. And Warren Buffett purchased shares anywhere from $33.50 right up to about $37 a share, to where there was basically no spread between the market price and a potential purchase price, which kind of reflected his view that he thought there might be something come out of this litigation. The final few purchases of shares that Buffett made were actually at $38 per share, which was actually a modest premium to what shareholders eventually got paid, which was $37 per share. But overall, from just that spread on the buyout, because he did buy most of the shares below the eventual purchase price, he turned $22.9 million of Berkshire's capital into $24.6 million, so a modest gain there. But the kicker was they ended up getting a lot of money back from the litigation. The court basically ruled in favor of Arcata. They ended up settling with the US government, and Berkshire got paid an additional $20.1 million over the next 2 years. So they turned what was a simple kind of 10% potential gain arbitrage situation into almost a double. Now, for several years, Warren Buffett has been very quiet on the arbitrage front. He really hasn't done a lot in the space, but in the last year or so, we've seen him enter into his first arbitrage situation in quite some time, which is with the company Activision Blizzard. Now, Activision Blizzard is another kind of classic risk arbitrage buyout kind of situation. As of recording the video, Activision trades at about $73 per share, and they have accepted an offer from Microsoft to be bought out at $95 per share, which is about a 30% premium now to the current market price. So that spread has gotten really wide. The reason it's that wide is because it's really not certain that the deal will go through. It's currently in the hands of a number of different international regulators, but Buffett has made the bet here. He knows that Microsoft have the cash to do it. It's really now just at the mercy of the other regulators. And to sum up how Buffett might think through a situation like Activision, he actually laid out the 4 questions that he believes you should be able to answer before going into one of these types of situations. He says, number 1, how likely is it that the promised event will indeed occur? Number 2, how long will your money be tied up? 3, what chance is there that something still better will transpire, a competing takeover bid, for example? And 4, what will happen if the event does not take place because of antitrust action, financing glitches, etc. So we'll have to wait and see exactly how the Activision arbitrage situation for Buffett here plays out, but he clearly believes he can answer all 4 of those questions, and he seems to have a view that he likes the odds in this particular situation. And I have a little bit of a hunch on this whole Activision thing. If the deal does indeed fall over and Activision shareholders don't get that $95 promised to them by Microsoft, because Berkshire was actually buying shares in Activision before this deal was announced. And I specifically say Berkshire there instead of Buffett because I said earlier that Buffett doesn't do this arbitrage stuff until there is a deal announced. But one of the other investors at Berkshire, either Todd Combs or Ted Weschler, did initiate a position in Activision in the fourth quarter of 2021. So clearly someone at Berkshire likes Activision at prices fairly close to where it trades today, and it seems to me that if this deal did fall over, I don't think Buffett would be too disappointed with just being a long-term owner of the business. So I hope you enjoyed some of these lessons from Buffett and some of the stories about previous arbitrage investments that he's made. He definitely stresses a few points throughout this that it really is just kind of a cash alternative, and his preference would overwhelmingly be long-term investments. But from time to time, he's found situations to earn really good rates of return on cash that would otherwise be sitting idle. So I hope you enjoyed the video. If you did and haven't subscribed to the channel already, please be sure to do so. But that's it from me for this one, and I'll see you in the next video.